Whereas ours, we could literally sell a $30 million apartment complex and move all $30 million in one transaction outside of your taxable estate.
Now I'm thinking about passing things off to my kids. How does this structure work with making sure the kids get the money?
Great question. Yeah, so the notes go for 10 years. At the end of 10 years, you can renew for 10. And then renew for 10, and just keep doing that. And then if you pass away, your kids, it becomes an asset inside your living trust. And so if you pass it on, your kids can inherit your position and start receiving the income off of it. Most of our notes earn 8%. After fees, they pay about 6.5%. So let's say in your scenario, it's a $10 million deal, which you would have had $6 million, but now you have 10. So you're earning about 8 on the 10 million. After fees, you're netting about 6.5%. That's your cash flow, right? You're paying ordinary income on that. Now that 10 million, you could cash out at any time, or your kids can. Now you're gonna pay tax if you dip into that principle of capital gains tax, but most of our clients like to pay the tax the second day to never. They're just gonna keep that deferred the whole time. Same thing as a 1031 to keep rolling it. But they cash out $1 million or $2 million and travel the world, do whatever you want with it. Now pay the tax on that. The other part of it is estate tax. Some of your listeners might be ultra high net worth individuals who have over 11 million if they're single, 22 million if they're married. Anything above that's going to be hit with what's called a death tax in the US or an estate tax. And it's 40% of anything above those numbers that's inside your taxable estate. So let's just say one of your listeners is worth $52 million and they're married. The first 22 million is exempt, but that $30 million is not exempt. Meaning if it passes, there's going to be an estate tax of 40% on that 30 million, which is what, $12 million. So their intent is to pass their wealth onto their kids, to be able to give more to charity, to be able to do a lot of good things, but they are stuck with this 40%. It's a big chunk of that 30 million. Enter the Deferred Sales Trust. Before they pass away, if they sell and move it outside their taxable estate with the Deferred Sales Trust, which they can, they save their kids 40% on, which is $12 million. So a very powerful way to also do estate planning simultaneously with the capital gains tax deferral with the Deferred Sales Trust. Whereas the 1031 exchange, all that does is just defer the capital gains tax. It has nothing to do with the estate planning. So most of your listeners who are high net worth may have done small amounts of incremental gifting, but they run out of those exemptions pretty quick if they're ultra high net worth. Whereas ours, we could literally sell a $30 million apartment complex and move all 30 million in one transaction outside of your taxable estate. So that right there is one of the single best reasons to consider the Deferred Sales Trust.
Oh, absolutely. And I know for myself, as I build my portfolio, I'm always thinking ahead with, I want to make sure, my son's able to take advantage of all of that. So this is great.